Something just changed in Japan that matters far more than most investors realize. As Japan dismantles decades of ultra-loose monetary policy, the global liquidity engine that has supported financial markets is beginning to shift. And at the same time, institutions are accelerating the move towards tokenized finance. In this video, we'll break down what's happening inside Japan, why Ripple, SBI, XRP, and stablecoins are becoming part of this transformation, and what these developments could mean for the future of global financial infrastructure. Ladies and gentlemen, Japan is entering one of the biggest monetary transitions in modern history. After decades of near zero interest rates and aggressive central bank intervention, the Bank of Japan is tightening policy. Government bond yields have climbed to levels not seen in roughly 30 years, and investors around the world are closely watching the potential impact on global liquidity. But here's where it gets interesting. While markets focus on rising yields and the possible unwinding of the yen carry trade, a very different story is unfolding beneath the headlines. Ripple and SBI are expanding digital payment infrastructure. Stablecoins backed by fiat currencies are moving closer to everyday use. Institutional interest in XRP continues to evolve, and Japan is becoming one of the first major economies where traditional finance and blockchain infrastructure are developing side by side. To understand why that matters, we first need to understand how Japan became one of the most important pillars of the global financial system, and why changes happening today would extend far beyond its borders. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Now, here's what most people miss. Japan didn't simply keep interest rates low for its own economy. It became one of the hidden engines powering global financial markets. This happened through something known as the yen carry trade. Mechanics sound simple. Investors borrow Japanese yen at extremely low interest rates. They convert those funds into dollars or other currencies. Then they purchase assets offering higher returns. That could include U.S. Treasury bonds, corporate debt, technology stocks, emerging markets, private equity, real estate, even digital assets. As long as Japanese borrowing costs remain low and the yen stayed relatively stable, this strategy generated attractive returns. Write this down, ladies and gentlemen. This is very important. See, over time, trillions of dollars in global investment became linked directly or indirectly to this source of cheap Japanese funding. It became one of the least discussed yet most influential pillars supporting global liquidity. But every financial system has a tipping point. When borrowing costs begin rising, investors can no longer finance positions as cheaply. If the yen strengthens or funding costs increase, those leverage trades become significantly less attractive. Many investors are then forced to unwind positions. Assets must be sold, loans are repaid, liquidity contracts. That process begins and doesn't remain confined to Japan. It ripples across international financial markets. Today, Japan is experiencing exactly that shift. Japanese government bond yields have climbed to levels not seen in roughly 3 decades. That may sound like an isolated development. It isn't. Bond markets serve as the foundation of modern finance. Virtually every major financial institution prices risk using government bonds. When yields rise sharply, borrowing costs increase across the economy. Write that down. Governments pay more to finance debt. Write that down. Corporations face higher financing expenses. Write that down. Consumers encounter more expensive mortgages and loans. Write this down. Asset valuation often come under intense pressure. Even modest changes in bond markets can trigger enormous adjustments throughout the financial system. Reports indicate Japan has been reducing enormous positions accumulated during years of extraordinary monetary accommodation. This is so massive that no one's paying attention. It's scary. We went over this in the Zoom call last week. Combined with higher yields, this represents one of the most structural, significant changes Japanese finance for decades has seen. Markets are watching carefully. because the world has never experienced a fully normalization of Japanese monetary policy after such an extended period of intervention. See, nobody knows exactly how this transition will unfold, but everyone understands its potential significance. See, history, ladies and gentlemen, has seen similar moments. One powerful example came during the collapse of the Bretton Woods monetary system in the early 1990s. For decades after World War II, most major currencies were linked to the US dollar, while the dollar itself remained convertible into gold. That system provided stability and predictability for international trade. But mounting economic pressures eventually made it unsustainable. When convertibility ended, the global monetary order fundamentally changed. Floating exchange rates emerged. Capital markets evolved. International finance entered an entirely new era. The transition created uncertainty. It produced volatility, yet it also laid the foundation for the modern financial system we know today. While today's circumstances are very different, history reminds us that major monetary transitions often create opportunities for entirely new financial infrastructures to emerge. And that brings us to perhaps the most fascinating part of Japan's story. While headlines focused on inflation and interest rates, another transformation has been quietly unfolding behind the scenes. Ripple and SBI Group have spent more than a decade building digital payment infrastructure throughout Asia. This partnership was never designed around short-term market speculation. Its objective has consistently been improving how money moves between financial institutions. Cross-border settlements remain surprisingly inefficient. International payments often involve multiple correspondent banks. Settlement can require several business days. Liquidity must frequently be pre-funded across jurisdictions. Costs accumulate at every single stage. See, blockchain technology offers an alternative. Instead of relying excessively on traditional correspondent banking networks, tokenized assets and digital settlement systems can potentially enable faster transfers, improve transparency, and more efficient liquidity management. Ripple has spent years developing technology aimed at solving exactly these challenges. SBI has become one of its strongest institutional partners. Write that down. See, together, they have steadily expanded their presence across Asia, while much of the broader market remained focused on speculative crypto cycles. Now, as Japan begins modernizing its financial infrastructure, that long-term positioning may prove increasingly important. But here's where the story becomes even more interesting and spicy. The conversation is no longer just about cryptocurrencies. It's increasingly about digitizing traditional money itself. Stablecoins represent one of the fastest growing areas of digital finance because they combine blockchain technology with relative stable fiat-backed value. Rather than placing national currencies, they are designed to represent them digitally. Japan has gradually introduced a regulatory framework that allows trusted financial institutions to participate in this emerging ecosystem. SBI has announced initiatives involving real USD stablecoins, while also preparing infrastructure connected to future yen-backed digital assets. See, the objective isn't simply creating another crypto token. It is building programmable digital money capable of operating continuously on blockchain networks. Imagine moving dollars or yens around the world instantly, ladies and gentlemen. Imagine programmable payments that execute automatically when contractual conditions are met. Imagine businesses settling transactions around the clock instead of waiting for banking hours. That is the broader vision behind tokenized finance. And unlike previous crypto cycles, driven primarily by retail speculation, much of this development is now being led by regulated financial institutions. This distinction matters enormously because when infrastructure is built by institutions operating within regulatory frameworks, adoption tends to become gradual, practical, and potentially far more durable than speculative market enthusiasms. One of the biggest mistakes investors make is assuming every blockchain development is primarily about price. It's not. In reality, Many of the largest financial institutions are far more interested in infrastructure than speculation. Their questions are different. Can transactions settle faster? Can operational costs decline? Can liquidity become more efficient? Can collateral move instantly across markets? Can compliance be automated? These are trillion-dollar questions. If blockchain technology answers even part of them, the long-term implications extend well beyond cryptocurrencies themselves. Price may fluctuate dramatically, sentiment may change week to week, but infrastructure continues being built regardless of short-term market cycles. As we've often discussed, short-term noise, long-term structure. And right now, Japan appears to be moving steadily towards building the long-term structure. The question is no longer whether digital finance is developing. The question is how quickly institutional adoption accelerates and what role assets like XRP could ultimately play as this new financial architecture continues to evolve. Because the developments taking place next could have implications not just for Japan, but for the future of the global financial system itself. This is where the story shifts from financial theory to practical implementation, ladies and gentlemen. For years, digital assets were often viewed as speculative investments, attracting attention primarily because of dramatic price swings. But the next phase of blockchain adoption isn't necessarily about speculation. It's about utility. Japan is beginning to demonstrate what that transition could look like. One of the most closely watched developments is the testing of stablecoin payments by Lawson, one of Japan's largest convenience store chains with more than 13,000 locations across the country and a growing presence throughout Asia. At first glance, paying for coffee or groceries with a digital currency may not sound revolutionary, but the significance lies beneath the surface. Every successful retail payment demonstrates that blockchain technology can function as a real financial infrastructure rather than simply an investment vehicle. If merchants can accept tokenized yen as easily as traditional electronic payments, settlement can become faster, reconciliation can become more efficient, and entirely new financial services may be built around programmable money. This is precisely how financial revolutions often begin. Not with one dramatic announcement, but through thousands of small transactions that gradually become normal. Now, this is what most people miss. Retail adoption is often the final step in proving that an underlying financial system is ready for broader institutional use. When businesses, consumers, banks, and regulators all begin operating within the same digital ecosystem, network effects can accelerate rapidly. This is why Japan's stablecoin initiatives are attracting attention far beyond its borders. Another major development comes from SBI's plans to offer lending services tied to stablecoins, with reported yields around 3%. That number may not appear extraordinary to investors in countries accustomed to high interest rates, but in Japan, where savers spent decades living through near zero or even negative interest rate environments, it represents a meaningful shift. For years, many Japanese households earned virtually nothing on traditional bank deposits. Capital often remained idle because there were few attractive low-risk alternatives. Digital financial products introduced another financial possibility. If regulated stablecoin platforms allow users to earn competitive yields while maintaining exposure to fiat-denominated assets, some investors may view them as an attractive complement to traditional saving products. Of course, yields always involve risk. The structure supporting those returns matters enormously, and investors should understand how any lending program operates before participating. But from a broader macroeconomic perspective, this demonstrates something much larger. Digital finance is beginning to compete directly with traditional banking products. Competition often drives innovation. Innovation encourages efficiency, and efficiency tends to reshape entire industries over time. This brings us to one of the most debated aspects of Ripple's ecosystem, XRP itself. There's an important distinction that investors should make. Stablecoins are designed to maintain relatively stable value because they represent fiat currencies. XRP, the anointed one, on the other hand, is a separate digital asset whose market price fluctuates. Supporters argue that XRP's role is not necessary to replace national currency, but to serve as a bridge asset capable of facilitating liquidity between different currencies and payment systems. Whether that vision reaches its full potential remains uncertain, but Ripple continues building products around that concept. If financial institutions increasingly require an on-demand liquidity across multiple currencies, bridge assets become one possible solution among several competing technologies. That is why institutional development surrounding XRP continue attracting attention. Prices reacting, systems evolving. They're not always the same thing. Markets frequently focus on short-term volatility. Institutions often focus on infrastructure that may take years to mature. Understanding that distinction helps separate headlines from long-term structural developments. One announcement that has generated considerable discussion was Evernorth's expansion into Japan with plans to build an institutional XRP treasury. According to public statements, the company intends to acquire XRP through open market purchases as part of its broader treasury strategy. If institutions begin allocating portions of their balance sheets to digital assets, demand dynamics could gradually change. This is so important. You got to write this down. Some market participants argue that institutional accumulation could reduce the amount of XRP actively circulating within the market. Others point out that supply and demand depend on numerous variables, including trading activity, investor behavior, and broader market conditions. No single treasury strategy guarantees higher prices. However, institutional participation often signals increasing confidence in an asset's potential long-term utility. Perhaps even more important than the purchases themselves is the message they send. Institutional investors are no longer asking whether blockchain technology exists. This is super important. They are increasingly evaluating how it might integrate into existing financial operations. So massive, you got to let this sink in. Changes on the horizon. See, this represents a meaningful evolution in the conversation. But Japan is only one piece of a much larger picture, ladies and gentlemen. Across the United Kingdom, dozens of major financial institutions, including firms such as Ripple, BlackRock, JP Morgan, Goldman Sachs, and other market participants, have begun exploring tokenization use cases through collaborative industry initiatives. Tokenization simply means representing real-world financial assets digitally on blockchain infrastructure. Those assets might include bonds, stocks, money market funds, real estate, private credit, and even government securities. Instead of existing slowly within traditional financial databases, these assets become programmable digital representations that can potentially settle faster and operate more efficiently. Many analysts believe tokenization could unlock significant economic value by reducing settlement times, lowering operational costs, improving collateral mobility, and increasing market efficiency. The exact pace of adoption remains uncertain. Regulatory frameworks continue evolving. Technology continues improving, but the direction of travel appears increasingly clear. The conversation shifted from whether tokenization will happen to how it will be implemented. Another important piece of this puzzle involves existing financial infrastructure. See, for decades, systems such as SWIFT have formed the backbone of international payments. Rather than disappearing overnight, many observers expect traditional infrastructure and blockchain technology to coexist during a lengthy transition period. Financial markets rarely replace critical infrastructure instantly. Instead, they evolve gradually. Banks test new technologies, regulators establish standards, pilot programs expand, successful systems gain wider adoption. This measured approach reflects the enormous responsibility involved in moving trillions of dollars through global financial markets every day. The future may not involve choosing between traditional finance and blockchain. Instead, it may involve integrating the strengths of both. The possibility explores why institutional collaboration has become such an important theme, ladies and gentlemen. History reminds us that infrastructure often determines which civilization thrives. Consider the construction of the Roman road network. The roads themselves were not the ultimate objective. They were infrastructure. But by allowing goods, information, armies, and commerce to move more efficiently across vast distances, it transformed the Roman economy and strengthened its influence for centuries. Today's digital payment networks may play a similar role. The blockchain itself is not necessarily the destination. It is infrastructure that could allow value to move across efficiently a digital global economy. That doesn't mean every project will succeed, nor does it mean every digital asset will become essential. But history repeatedly shows that societies capable of improving the movement of information, capital, and commerce often gain significant economic advantages. There's also another comparison. During the Industrial Revolution, factories did not become transformative simply because they introduced new machines. They became transformative because they reorganized entire production systems. Transportation improved. Supply chains evolved. Finance adapted. Labor markets changed. The machines were only one component of a much larger structural transformation. Blockchain technology may ultimately follow a similar path. Its long-term impact may depend less on individual tokens and more on how financial systems reorganize around faster settlement, programmable assets, and digital infrastructure. The technology itself is only one part of the story. The system surrounding is what truly matters. So where does all this lead us, ladies and gentlemen? Japan finds itself at an extraordinary crossroad. One side, the country is navigating one of the most significant monetary transitions of modern history. This is so important, ladies and gentlemen. You got to understand it's so important. Higher interest rates, rising bond yields, the gradual unwinding of policies that shaped global markets for decades. Those developments created uncertainty. Markets rarely adjust smoothly to structural change. But on the other side, Japan is simultaneously becoming one of the world's most important laboratories for regulated digital finance. Ripple and SBI continue expanding payment infrastructures. Stablecoin initiatives are moving towards real-world implementation. Interest in XRP continues evolving. Retail payment pilots are testing practical adoption. And globally, some of the largest financial institutions are exploring tokenization as a potential foundation for the next generation of capital markets. Will every initiative succeed? Probably not. Will adoption happen overnight? Almost certainly not. Financial revolutions tend to unfold gradually before appearing suddenly in hindsight. What matters is distinguishing temporary headlines from long-term structural trends. Short-term noise, long-term structure, prices reacting, systems evolving. Those two ideas may define this decade far more than investors realize as well. Because you got to understand something, you've got to pay attention to what's quiet, ladies and gentlemen. See, whether you're optimistic about XRP, interested in tokenization, or simply trying to understand where the global finance is heading, Japan offers an important case study. Because what happens there may influence payment systems, capital markets, and digital finance far beyond its own borders. The world is watching central banks, but behind the scenes, another transformation is quietly taking shape. One blockchain, one institution, one payment network, and perhaps one transaction at a time. Ladies and gentlemen, if you enjoyed this deep dive, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss our latest macro and digital asset analysis. Let us know in the comments. Do you believe Japan's shift towards tokenized finance will accelerate globally adoption of XRP and stablecoins? Or do you think traditional financial systems will remain dominant for much longer? As always, thank you for watching, and I'll see you in the next one. Hope everyone's having a blessed afternoon. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Well, it's a tale of the same thing we go over every day, ladies and gentlemen. Right now, with the markets, King Dollar Daddy is really running amok on everything. With hostilities expected to increase next week, targeting infrastructure, all risk off is coming out of the market. Any fund manager, anybody at a trading desk that needed a reason to cover and be square has got it right now. So as the DXY continues to march higher, look out below for everything else. That's just what it is. So you got a tale of chaos competing with lower inflation. The lowest has been since COVID. Go figure. The thing I want to point out here right now is what you need to pay attention to is levels. Ladies and gentlemen, one good tip in the pits can easily pay for your entire year subscription. If you're looking for the deeper macro research and you want to learn how to take advantage of all this, come and join over 600 active traders and investors inside the Patreon, the Crypto Public Desk Monthly. If you want to learn to trade, you want to learn to invest, this is one of the most pristine times to learn all of this. And again, I believe, and this is not financial advice, just my own opinion, I entertain any capacity. As the narrative pushes the dollar stronger, everything else gets crushed. Tomorrow we got news about clarity. Today we had another ETF from T. Rowe go. The change is happening, ladies and gentlemen. Slowly than most people expect. But that's why I always tell you to pay attention to what's quiet. Because quietly, the world is rewiring itself. See, everything I went over in this video is massive. I bought my first house from the carry trade. Now, the fact that someone can offer yields to Japanese investors is astronomical. But I go back to a lot of things I harp on. These rock bottom prices for cryptocurrencies are going to vanish like a mirage, and they will be in the rearview mirror. Accumulating for what's coming is most important if it makes sense to your financial situation. But right now, you got a lot of reasons to be excited. You got a lot of reasons to be anxious. But what a time to be alive. It really, really is. If I had to play this from a retail perspective, I would be playing this twofold. First, I'm watching the DXY and the dollar. That's the reason for the move and the excuse for the move, depending on what side you are of the equation. The reason, if you're on the reason side, you're playing moves for a reason. If you're on the excuse side, you're playing them for an excuse. You have to have one. You can't have both. Looking going forward, I'd be playing the reason. And I've been telling you this at these points in our video for weeks. Kinetic energy and action was going to begin again. And it never stopped. It was just repackaged. The Harry Houdini freak show continues. So if you want to see and take advantage of the metals, gold, silver, platinum, palladium, copper, WTI, come and join the Crypto Public Desk Monthly. I hit you with a lot of things here, ladies and gentlemen. The only way to learn is to get into the arena. As financial mercenaries, every day is a battle. You use the excuse or the reason to win each battle daily so your account goes higher. And you don't get caught up like sushi here. You don't FOMO this. You don't FUD. When we get to extreme points of the trenches, you got to pay attention here. I, for one, this is pike a day, pike a night. I would not be going into the market for no reason right now. There's too many things converging at once that could cause massive move one way or the other, causing people to get caught up like sushi. What I'd be doing right now, I would be solely accumulating without leverage, XRP, ICP, all day, every day, ladies and gentlemen, and forgetting about it. But when it comes to positions, options are ruled in the day right now. Options are. Again, hostilities could flare up a lot worse if infrastructure get hit. But you got changes happening in the gold market. You got changes happening everywhere, ladies and gentlemen. I love you all. I'll see you on the front lines. None of this is financial advice, just my own opinion. This content is for educational, informational purposes only. Should never be taken as financial advice. Always consult your licensed financial advisor. Never invest money, ever. Never, 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 never. Based on watching a YouTube video. Don't do that. Ladies and gentlemen, I tell you to pay attention to what's quiet because everything's quietly changing. See this trading and investing. And look, if you want to learn to trade and invest, there's never been a better time because that's a lifelong vocation. Come and join the Crypto Public Desk Monthly. Come and join over 600 active traders, investors. Doesn't matter where you are. We're capping that at 1,000 people. We just can't handle anymore. And, it's just too much. But look, why I say it's pike a night and pike a day. You have markets being moved by tweets, deaths of 1,000 tweets. You got hostilities increasing. You got crude trying to push past 80. I believe the news will be narrated by the oil price. If oil goes too high, they'll turn it down. If it goes too low, they'll turn it up. What I mean by turn it up is that hostilities can increase a bit more. This is what I'm paying attention to, ladies and gentlemen. But there's a purpose of being before ex ante's things. You got to learn to do that. You got to understand that. So to me, as the narratives continue, the sushi will be fresh. As the remora, we swim underneath the apex predator. Now, as this frosty march up this frosty mountain gets crazier and crazier and colder, enjoy your frosty beverage. But understand why you're in this. Why you're in this market. I want to know in the comments why you're in this market. There was a comment that I didn't get to answer about someone discussing his children thinking that BTC and Ethereum is better than XRP, the anointed one, and ICP. And that this comment's going to age very, very well in this video. I would answer your question in this video right now if you're watching, brother. You'll have the last laugh with this one because Those are yesterday. Tomorrow is coming. The utility is coming. This cycle has got nothing to do with retail hype whatsoever. The big boys are in it. Crypto is going into the Mariana Trenches. It's not going to be designed or driven anymore by what it once did. Everybody's using it. So if you've watched this whole video, hold the line, brother, because you're going to have the last laugh. You can see the changes coming. It's part of like some of the arguments I had in the refining industry when we were first movers into certain areas, solvent extraction, electrolying. People thought that we were insane. We got into that because of a workaround, because we couldn't own land places, right? But at the same point in time, it was more economic, and we turned a bigger profit. I love you all, ladies and gentlemen. Tomorrow is going to be a big day, baby. Get excited. Remember why you're in this. Because I'm telling you now, after the midterm elections and some other things come, these prices are going to be a mirage. I love you all. See you in the front lines. Oh, getting caught up like sushi. Not financial advice, my own opinion. Never invest based on watching a YouTube video. Always consult a licensed professional. I love you all. I'm going to see you on the front lines.